All right, thank you everybody for joining us today and to learning a little bit more about what it takes to make money and investing in the multifamily apartment real estate space. My name is Yuen Yung, and I'm glad to be here with you today to share some of the behind the scenes of what we do at Upside Avenue and Custodial Capital when investing in multifamily communities and as an investment property. To start off, I want to give you a little bit of background about our company and the history of our company. We have been in business for over 17 years. Our company has been in the capital world and providing investment opportunities for folks since 2015 as Custodial Capital. And then from there, we launched our REIT, which is Upside Avenue, which is now live and available to retail investors. And through that process, we've done over $1 billion in transactions. And in addition to that, with the REIT in particular, the Upside Avenue, what we've done there is provided a product that is available to all investors with low barriers to entry, as little as $2,000 in investment to start off. And it invests in the multi-housing sectors of student housing, apartment complexes in multifamily, as well as senior living. And so it is a publicly non-traded REIT that is available to all for those that want to get into the multi-housing sector. All right, moving on, let's talk a little bit about today. What are the topics we're going to cover? There's three specific areas and main points that I want to go over with you folks today. And those are really the ideas around, number one, what are the key things we are looking for when analyzing a multifamily project? Number two, what assumptions do we make when doing underwriting a project? I think the assumptions are very critical to help us understand if the project is going to actually perform. And then finally, what kind of returns can investors expect in today's marketplace and climate? As things have shifted over the last 10 years, we'll get a chance to talk a little bit about the climate and what we can expect today. All right, so let's start with the first area of conversation, which is what are the key things when analyzing a multifamily project? The first thing is we're really always looking for what we call an arbitrage opportunity. And what we mean by that is that we're looking for disparities or inefficiencies in the market where we can buy a property at a lower than expected market pricing, or if there is an opportunity to find something that has what we call a value add opportunity. And I'll explain more of that in just a second. And then the final piece is really under property management, where there might be mismanagement. So I'll start back from the top of understanding when we mean property selling at a lower than fair market value. With the market, because the real estate market in multi-housing and multifamily are really not necessarily always efficient, what we have a lot of times is the ability to buy properties at a better pricing than fair market value. And the reason this happens is a lot of times what you'll find is that with the cost of real estate and the size of properties, not everyone can participate. Meaning that what happens is if you're trying to buy, for example, a 300 unit apartment complex, well, the average price of that classification of buying that 300 unit property might be close to somewhere around $30–40 million. Well, just on sheer pricing, what happens is not everyone can participate, meaning your average investor can't go and try to buy that property because you would need at least, $30–40 million ready to go, whether you're qualifying that as debt or as equity. And so what we're able to do is be able to go in there and have cash ready to buy those projects and be able to negotiate a better price. In addition to that, because we have capital ready to go, oftentimes the speed of our ability to actually get the deal closed incentivizes the seller to give us at the pricing that we want. And so that allows us to have some leverage on being able to get the pricing down. The other arbitrage opportunity is really around the value add component. And what we mean by that is sometimes when you look at certain properties and certain communities, you might find that maybe they're not aesthetically the most pleasing. but yet we can look into those properties and say, you know what, if we did some construction or some remodel and beautification, then we're able to actually increase the value. And that gives us an arbitrage opportunity to actually take what we buy and actually force the valuation to go up because of the work and construction that we do, both on the exterior and interior of the community and the property. And then finally, on the property management, what we mean by arbitrage there is that sometimes what you find is because these complexes are big, property management might not be doing their job or not doing their job well. It takes a lot to be able to organize and run and manage these communities. And so a lot of times maybe they're not able to push the rents to the levels that should be gotten. Or maybe they're not maintaining or taking care of the residents, and the residents are unhappy, and they're showing that on social media or other areas where people maybe are complaining. If you have the ability to go in and take over and run these properties, and you do it better and you have better management, what will happen is what you'll find is the value of the property will always increase. And so that's what we mean by arbitrage opportunities. Whether it's a mismanagement, whether there is maybe some sort of remodel or value add component that we can get, or just quickness of ability to actually acquire the property. So all of those things combined give us what we call our arbitrage opportunity. All right, second part, when we talk about location. So as you probably have heard many times in real estate, the three most important things in real estate: location, location, location. When you look across the U.S., it's not just as simple as just going out there and saying, oh, well, I see an apartment complex in my neighborhood, I should buy it. It doesn't work that way. In the multifamily space, when we're underwriting and we're looking at what types of properties we're going after, we're very focused on a couple of key areas. Number one, population influx. The states that have the most influx in population have the most demand typically for apartment complexes and multifamily properties. And so therefore we focus on where is the population going and where is the job growth. As job growth increases and incomes increase, then our rents increase and the demand for our product increases. And so today we are very focused on Texas, Florida, Carolinas, some of the Sun Belt regions. Those are the areas that we are really focused on, and we do a lot of data research around figuring out where we believe the population migrations are happening and where the job growths are happening. Where are some of the technology companies that are going for HQ2 or HQ3? Where is the money being invested into infrastructure and city infrastructure? Those are the ideas around what we look for so that we can find the best potential property available to you. Now, on the final piece, that is really around property type. Now, what we mean by that is that we have a very specific niche model of the type of category that we want to look into. Number one is what we call classification. So in the multifamily world, we look at classification as Class A, Class B, Class C, and on down. And similar to when you're in school with different grades, A is your top of the line, nicest, what I call resort style amenities type of multifamily apartment complex. Class B maybe has less amenities, maybe the property is a little bit older, and then Class C starts going down from a grade level down from there with even less amenities and maybe even older property. Specifically to where we feel like there is the opportunity in the property type is really what we call the Class B, Class C. We're looking for vintages typically from the years of 1980 to about top part of 1990s. And then on top of that, we're also looking for properties that are at least over 200 units or bigger. And we want people, we want the population that we are renting to be renters by necessity and what we call workforce housing. And when we look at the categories of those requirements combined between Class B, Class C, 80s, 90s vintage, bigger 200 units or more properties, renters by necessity. When we combine that, that creates what we call our niche. And that is what allows us to go in there and be able to find better returns for investors, because by sectoring this niche, what we find is that this niche has probably the most what we call meat on the bone on the deal, meaning the most arbitrage opportunity to get us to where we want to go. All right, looking into the next area, underwriting assumptions. So what do we mean by underwriting assumptions? Well, in all business, when you get into business, you typically have a business plan, and you have to project out what you believe money coming in is going to look like, what we call revenues or income, or dollars going out, the cost of doing business. And buying properties and investing in properties is no different. So the factors that we have to look at is first on the income side. So when we do underwriting, we have to look at what we believe the rent growth will look like, how much money in terms of capital expenditures that we have to put in, and then how long do we have the asset for appreciation. And when we take a look at that approach, what we find is that our approach is what I would consider probably a conservative approach of understanding where the market is, what can we really do in terms of maximizing rents so that more people want to rent from us, number one, from occupancy standpoint, and then number two, pay us more because we're able to provide maybe better amenities or better living conditions. The second part is that we have to calculate in underwriting how much money we have to put into the project, meaning our capital expenditure. What we have to be able to do is be able to put, for every dollar we put in, we need to get X amount of value in terms of a sale price or increase in rent. And by being able to do that, what we're able to do is actually calculate what we call an ROI, return on investment. So if we're putting $1 million in, we would expect that we would get a couple $1 million of value out of it on the back end, and therefore allows us to safely put money in and invest the money. And then the final piece is what we call the holding period. Real estate appreciates fairly naturally over time, but there's a sweet spot to that, meaning that at some point, if the property continues to get older, you're going to need to put more money back in. So what we want to be able to do in underwriting is be able to grow the rents, put in the money that we need to put in to get to the rent growth and the value appreciation that we need to. And then at some point, typically 3 to 5 years, we would let that asset go, meaning that we would sell it to maximize our full potential of value before more maintenance or costs have to go back in. So those are the big pieces of assumptions when we look at underwriting. The final pieces of the underwriting is what our exit would look like. So in all good business, you have to consider getting into business, what it takes to grow that business, and then finally, how do you get out of that business, and what is what we call exit strategy. In real estate, on the exit strategy, we're always looking at the market and where other properties are selling for. But for us, what we're trying to do is force that appreciation and increase that value so that we get the highest possible sale price at the end of the life cycle of the 3 to 5 years that we would hold it for. The key there is not to be too aggressive, even though we're very confident in what we can do in terms of renovations and tenant mix. But really, at the end of the day, we want to make sure that we are assuming that what if it's a down market? What if it's not a great market to sell? And based on those ideas, we underwrite a very conservative figure to say, yeah, we gotten rents to this point. Yes, we put in this money to upgrade and improve the property. Therefore, we think we can sell it at some price point. And that is a forecast that we would have to do. The combination of doing all these pieces on the underwriting, what that really at the end of the day allows us to do is give you a safe feeling of whether or not we can actually accomplish the returns that you're actually going to make. So when you see returns from us and the projections from us, we're not being aggressive of saying that we think we can over and outdo the market, but rather safe and conservatively, we feel like we can accomplish the rate of return that you're looking for. All right. Finally, what expectations of returns for investors in this market? Well, I will tell you that the market has shifted a lot over the last 20 years, the last 10 years, and now the last 3 or 4 years. In this market condition today, with prices having appreciated and rents appreciating quite a bit over the last 10 years, what we're seeing is a little bit of a flattening of the hockey stick that we saw over the last 10 years. Not that we don't think we can get returns and growth out of this market, but rather it's just not going to be that huge exponential return that we had seen over the last 10 years. So in today's market, what we're expecting is probably what we would call mid-teens IRR. And what that means is it's somewhere around about a 15%, 12 to 15% return. And IRR stands for internal rate of return, meaning that over the life of you holding the investment, the 3 to 5 years, you would have averaged somewhere around 12 to 15%. What we expect there is that the areas that will give us the ability to hit those types of returns for the investor is really going back to what we talked about, which is our location and the niche that we're in. Now, right now, a lot of people are saying we're late in the cycle, meaning that a lot of the appreciation has happened. But what you'll find is that in the multifamily space and the apartment space, it's fairly recession-proof. And the reason why is because we're targeting what we call workforce housing, meaning that even if the economy shifts and has a downshift, these people still have to rent, and they will continue to stay in the place and continue to live where they live. So that gives us a big leg up that if there are fluctuations in the economy, we're still able to produce a positive return and cash flow for the investor, which gives us an opportunity to also then, if there are any big adjustments in the market, probably come in and give us an opportunity to buy even more. So kind of the buy low, sell high theory. Also, the other thing that makes us feel comfortable of accomplishing this 12 to 15% return is really the demographics that are coming. And we'll get a chance to share a little bit more about the demographics here with you. So when you look out over the next years in terms of who the renting population is and what it looks like, what you'll find is that the 20 to 34-year-olds, what we call the millennials and the Gen Z, you can see that for over the next decade or more, we are still continuing on an up ramp. And the millennials and the baby boom generation are actually the two demographics right now that are the highest in terms of renter demographics, meaning that as the millennials and Gen Z come into the workforce, they tend not to buy houses, they have consumer debt, they have student loans that they have to pay for, therefore they are renters by necessity. But then what's interesting is also that the baby boomers are coming in. And when you look at the baby boomers, as they become empty nesters, they're wanting more flexibility, they want to travel more, and the burden of actually owning a home has become much more challenging. And so because of that, they're also then adding to the demand for renting. And so that has then pushed the multifamily space up. So the combination of all the demographics has really helped us through that process. All right, taking a look at the next piece of it. What you see here is that, when we talk about people who want to grow in real estate, well, there's a great quote by Theodore Roosevelt that says, "Every person who invests in well-selected real estate in a growing sector of a prosperous community adapts the surest and safest method of becoming independent, for real estate is the basis of wealth." And that is the foundation that we've grown here in the U.S., is that we have the ability to actually own land and own property. And we believe that in terms of investing, that's really what allows us to get to where we are. So as you can see, we really take our time and make sure that investments are profitable for the investor. We're looking at very specific key factors when determining the likelihood of multifamily and what it brings in terms of solid returns. And as you've learned, multifamily is really a recession-proof method of investing because there will always be a demand for workforce housing. And no matter what the stock market is doing, we're able to produce a solid return for you. All right. So at this point, I'd like to turn it over to my co-presenter. We have some questions coming in. So let me try to answer those first, and then we'll turn it over. All right, let's see. It says here, what is your typical waterfall structure, preferred return, cash flow split? So what the question here the listener is asking is really, how do we structure the deal itself? So when we buy a deal, the way we structure it typically is that we will give some sort of preferred return, somewhere around 6 to 8%, meaning that the investor gets the first 6 to 8%. And then after that, we will have some sort of 1-tier, 2-tier, possibly 3 tiers of splits of profitability. So in general, today, in today's market, 6 to 8% preferred return. And then after that, typically I would say anywhere from a 70 to 75% split with the investor, meaning that every additional dollar that we earn after your 8%, we would split 25 cents to us and 75% to you. That would be pretty average or typical today. All right, next question. This is 15% IRR. What approximately is the cap rate? Well, to answer that question, that's really two separate items there. In order to achieve the 15% IRR, I think the question is, in order to achieve that IRR, that return, what is the cap rate that we are typically underwriting towards? Today, in this market, depending on the market, we adjust our exit cap rate relative to which city or area that we're in. We're seeing cap rates today anywhere from a low of 4.5% to a high of about 6.25%, 6.5%. So when we underwrite, what we do is then we would typically underwrite and exit out at some sort of cap rate around today. In today's market, we're projecting out, trying to underwrite out to 6 to 6.25% to achieve our IRR. All right, next question. How can we evaluate the risk? Do we look at particular investment and participate in that investment, or do we aggregate our funds? Specifically for the Upside Avenue REIT, you are in an aggregation. So meaning that we are the ones making the decisions on the investment vehicles themselves, the properties themselves. So you would not be able to pick and choose which property you're going into inside the Upside Avenue REIT. We handle that, and what we do is we go out and pick those investments through our criteria that I've mentioned so far. And so that's how we get there. On the rental chart, what are the numbers to the left? Oh, that is the amount of renters in the form of millions. So you can see that there are a lot of renters through the population growth. Next question is, beyond the split after preferred to investor, what other fees do you charge on the investment? Specifically for the way the REIT works is that we charge 2% in management fees, and then a 1% on disposition fee. 2% on disposition fee. That's about it. The only other cost to the REIT itself is really that we spend up to about 3% for any sort of organizational or offering needs that we have. So really that's it. So when you look at the 12 to 15% return that you can get on the Upside Avenue REIT, that is net of those 2% fees and on the front end, ongoing, as well as the back end at disposition. Are you taking out debt or buying 100% when investor funds? Great question. So in the investment, what we're doing is we typically leverage, meaning that we do take out debt anywhere from 60 to about 75%. So we do leverage, so we do have the ability to take debt so that we can have cheaper capital in order to enhance the return. So fantastic question. All right, last one. As an investor, do I get a K1? Or since it is a REIT, capital gains, dividends, and ordinary income. So under the Upside Avenue, because it is a REIT, you actually get a 1099. So you're a shareholder in the REIT as opposed to ownership into the actual property itself. The REIT is the owner of the property. You are the owner of the REIT. Therefore, you get a 1099 instead of a K1 at the end of each year. All right, I think that was all the questions. So perfect. I'll let you take over, Jessica, and transition.
All right, so thank you so much, Yuen, for taking the time to tell us more about how to, what to look at when we're looking at multifamily real estate investments. I'm going to turn the time over now to Scott Maurer from Advanta IRA, and he will take us through how to invest.
Yep. Right. Jessica, thank you very much. Can you hear me okay?
Yes.
All right, great. I appreciate you all having me on, and wanted to talk obviously to the individuals who are listening today, really about a way that if you're looking to invest in multifamily real estate and looking to get into uh, a deal, a different way to use it. A lot of people don't think about the fact that you can use an IRA account or use maybe an old 401k to actually invest into that space. Everybody looks at their savings account, money in their checking account, and don't even really think about the fact that you can use an IRA account to make these types of investments. So in my time today, I'm going to kind of share a little brief overview about how that process works in making an investment in multifamily using an IRA account. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for several years. I've seen a lot of different types of investments here at Advanta. We've seen a lot, though, lately, a lot more, at least I should say, in the multifamily space. People investing, and rather than going out and buying a single family home inside their IRA account, actually putting their money to work in maybe 2 or 3 different development projects and getting a little bit more diversity there. So during my time at Advanta, I've again seen a lot of different types of investments. It's just that multifamily lately seems to be extremely hot. I am a licensed attorney under the state of Florida, although at Advanta IRA, we don't give any legal, tax, or investment advice. We also do not specifically endorse any products or any other companies, even companies who we've worked with or our clients have worked with to make investments. At Advanta, we're not going to do the due diligence. That's why it's important to team up with a company or individuals that can help you evaluate a particular offering, a particular deal, or even if you're buying that property down the street in your neighborhood. Our job is to do record keeping and administration for your IRA. It's basically to act as a Charles Schwab for you, in a sense that you're going to go out and find real estate. We're just going to do the reporting and receive all the income for the investment, but we don't provide any products. Again, we don't give any legal, tax, or investment advice. Now, if you are looking for those particular avenues, we have attorneys, we have CPAs, other tax advisors that we can certainly refer you to, who can help give you more information about either self-directed, if you have a question regarding a self-directed IRA or IRAs in general, or maybe more on the legal side of things as well, and the investment side of evaluating a particular offering. Just a little bit about Advanta. We've been in the industry over 15 years. The only thing we do is administer self-directed IRA accounts. We don't have any other businesses that we're affiliated with. We strictly act as a record keeper and administrator for people who, again, have money in their IRA or an old 401k and want to put that into what we consider to be an alternative asset, which I'll go over in just a moment. We currently hold over $1 billion in assets through our accounts. We have offices in both the Tampa area and also Atlanta, but we work with people nationwide. And one of the benefits, I think, to working with us specifically is that for every new client that comes to Advanta, we assign them to one individual who really gives them a personal service. So you're not calling an 800 number and getting the next available representative to help you regarding your account. You're simply going to have a one point of contact here at Advanta for making your investments and maintaining your investments, and certainly getting any questions you have answered as well. Now, for those of you on the call who maybe haven't heard of a self-directed IRA or wondering maybe why only recently you've heard of a self-directed IRA, it's really because most IRA accounts that are in existence, most people who have their IRA accounts have their account with a bank or maybe with an investment brokerage firm who's offering them limited investment products. I might have an IRA with a Fidelity where I can invest in a variety of mutual funds or stocks, or I might have a IRA at a bank CD, but those companies are only offering you what they sell. IRS regulations do allow for a very broad range of investments. There are a lot of different things the IRS is willing to, I guess, basically saying allowing you to invest in with your IRA account. But the IRS does not require each IRA custodian to offer all of those possibilities. So banks and brokerage firms over the years have made the decision to limit their IRA holdings to simply those assets that they sell. Again, mutual funds, stocks, other types of publicly traded securities. That's typically what they specialize in doing. Self-directed IRAs only account for the best guess we have is around 4, maybe 5% of all retirement plan investments. So it's really probably a matter of most people haven't heard this is possible rather than people choosing not to. Because again, if I have my IRA with a bank or a brokerage firm, they're not going to advertise to you that you could take your money and invest in a multifamily project or invest in a piece of real estate. And really, kind of the over the years, the people that I've talked to, and certainly that have come to Advana over the years, why are they choosing to self-direct? Why would someone take that step of, I have money in my IRA account and I want to place it into a different investment? Usually they're going to fall into one or more of the buckets here on the screen. For many investors, the IRA is simply providing a new source of capital for them. So they maybe already invest in real estate, or they are looking to place additional funds into another real estate investment. For these clients, the IRA is simply providing them with this extra source of capital. Basically, they have more cash that they have in their IRA they can use. Again, they don't want to touch their savings account or don't want to touch their checking account either because that's their rainy day fund or because there's not enough funds there to make the investment. When they discover what a self-directed IRA is and what they're allowed to do with one, the IRA just becomes a new source of capital. For some clients, there's the tax benefits. When you invest in an IRA account, the income that is generated comes back tax-free to your IRA account. So if you're making that you're making an investment with some large potential returns, you might rather have that accruing inside an IRA account, either tax-deferred or tax-free, so that it's not going on your personal tax return on an annual basis. And then again, another reason, stock market fatigue. The ups and downs, we've seen some ups and downs this week alone, but over history, people know that the stock market does rise and fall. And a lot of times it's rising and falling to, relating to things that they have absolutely nothing to do with. So if I have my IRA in the market, and there's geopolitical events going on that I have no control over, my retirement account suffers through no fault of my own and nothing that I was doing. So people want to self-direct. They could take their money out of that kind of risky arena, put it into an investment that they feel more comfortable with or that they have a little bit more control over. So it allows them to sleep better at night. So again, a lot of people, it's one or more of these buckets that they're falling into. A lot of clients, hey, this is the source of cash I can use for an investment, and I'm getting some of my money out of the market at the same time. For people who are raising money, why are self-directed IRAs a good capital source? If you're looking to do deals, IRAs are easy for repeat investors. Again, people who are already using their IRA, already investing with you personally, can simply reinvest or invest in a new project using their IRA accounts. You can just go back to your existing database of leads and investors and show them a different way of making an investment in your next project. And again, a lot of people are not planning to touch their IRAs for many years. Have a 401k or have an IRA. That money is for when I get to 65, age 70 years old, and I'm not going to touch it in the meantime. So I'm going to put it in a multifamily investment where I might be held up for 4 or 5, maybe even 10 years. That doesn't bother them. Now, if you ask them about investing their savings account, which is kind of their rainy day fund, if they were to lose their job or have a major health issue, they may need that capital for those unforeseen expenses. So an IRA usually is the last place somebody will go for capital. So the more people are more likely to use their IRA for longer term investments. And again, as we were just seeing with Yuen talking about returns, in the real estate market, a lot of people, again, sitting in money markets, CDs, maybe even in some low-risk mutual funds, just not getting a great return, and realize that's not a good long-term scenario. But they're afraid of putting the money back in the stock market or putting it in riskier funds if there's going to be any type of correction. And another reason why IRAs are good capital source, there's no outside approval needed. It's simply the IRA owner. If it's your account, that means it's you making the decision to simply, I want to use my IRA, invest in this next multifamily property, or buy that property down the street. It's just up to you. And if you're raising money from individuals, again, same concept. If you sell an individual on investing with you, if they're using their IRA, that's all you need. You don't have to go to a bank or get any other outside approval to get that IRA put to good use. Now, when we talk about self-directed IRAs, it's important, obviously, to understand what types of accounts can be self-directed. So being a self-directed IRA, that means any type of an account that is designated as an IRA can be self-directed, and that includes your traditional and Roth IRAs, which are just individual accounts. Anybody can typically have one. The only difference between a traditional and a Roth is the tax treatment. If you're not familiar with the differences between the two very quickly, traditional IRA, you get deductions for contributions into the account, but that money is going to grow tax deferred. You will pay tax on that money when you reach retirement, but you get the benefit of accruing your money more quickly as you don't pay taxes as you grow the account, only when you pull it out. The Roth IRA gives you that same benefit of growing your money tax deferred and not paying taxes as you go. But the added benefit with the Roth is that your money actually comes out to you completely tax free when you get to the age 65, 70 years old to take distributions. But you have to pay the tax on the money going in. So it's kind of a little bit difference between the Roth and the traditional. If you're self-employed, there are SEP and simple IRAs that allow you to contribute more money each year into a retirement account than does traditional or Roth IRA. Again, we see a lot of SEPs and simples with self-employed individuals and small business owners. The big account, though, place I think gets missed at times, people forget about. When you talk about self-directed IRAs, they think, I don't have an IRA, I don't have a traditional, I don't have a Roth. But they do have an old 401k, they have an old 403b plan or a 457 or a TSP. Basically, they worked for an employer. They had a retirement plan with that employer, but they've now left that employer. Either they quit, they were retired, they got laid off. That money, once it's no longer with your current employer, and it's a foreign employer's plan, that money can also be used to be self-directed and simply rolls over tax-free into a traditional IRA. Now, the one account that's not on this screen that you do have to look into often is a current employer's 401k. So if I have a 401k through my company that I'm working for now, they are permitted to place restrictions on my ability to move that money out of the plan. So for current 401ks, you may not have access to use that money in a self-directed capacity. But any former employer's plan, you absolutely can. Now, if you have money in one of those types of an accounts, there's two mechanisms that you use to get that money then transferred into a self-directed IRA and in a position then to make this alternative investment. You can either do a transfer, a trustee to trustee transfer, which is moving money directly from one IRA to another. So if I have a traditional IRA or a rollover IRA at Charles Schwab, I can open up the same type of IRA here at Advana and do a direct transfer where Charles Schwab submits the funds to Advana. The money doesn't touch your hands. It's a tax-free movement of money. So you can actually transfer money as often as you'd like, and you can do it in partial amounts. So I don't have to move my entire Schwab account over to do self-directed if I only want to use a portion of it. I can move over just what I need in order to do that. Now, direct rollovers occur when you have that money in a 401k. So you worked for an employer for a number of years. You now want to take that money and self-direct it. It's just a different term, a little bit different process to do a direct rollover, but the same principle is involved, that the money is coming directly from your 401k into the IRA account. Again, a non-taxable movement of funds. And as you see at the bottom, transfers and direct rollovers are unlimited. Okay, so you can move money around as long as it's not touching your hands. There's an unlimited amount of times you can move that money. Typically, the process takes anywhere between a few days to a few weeks, depending on who the other custodian is that's involved. And again, the other thing at the bottom of the screen, earnings within an IRA are unlimited as well. So if you're looking at, again, an investments with great returns, that can all just go back into your IRA. There is no cap on how much you can earn within your IRA at a given year. So the types of assets, once someone has set up an account, done a transfer or a direct rollover, the next step for them is to tell us ultimately what they want to invest in using their IRA. Again, at Advana, we're not going to tell them they should place their money into a particular investment or try to sell them an investment. We are waiting for the client to drive the ship and tell us, here's what I want to invest in. And when it comes to real estate, that can be anything from a single family home that you're using for a long or short-term rental or just a flip, to private notes and mortgages, mobile homes and parks, tax liens, REITs, both obviously publicly traded and privately held, syndications, multifamily. the common thread with most of these assets, again, is that brokerage firms and banks, going back to one of the first slides I had, will not hold these assets. It's not that they can't, it's that they choose not to because it doesn't fit their business model. And that's why Advanta IRA exists, to allow you to keep the tax protection and benefits of your IRA, but open your IRA and open your account up to much different investment possibilities. So gone through the process now, you've opened up the account, you've done a transfer or rollover. Now you've identified a particular piece of real estate that you want to invest in, or a multifamily. Let's say this, we're going to use a private placement for an example here. How does that process going to work? So again, Advanta is not going to provide you with a list of investments. So in this case, our investor Jane meets Randy, who is private offering. He's going to purchase and remodel an apartment complex. That's his goal. Again, raising capital from a number of different sources, possibly using some leverage as well. He is going to provide Jane with the subscription documents and a prospectus. So he's going to basically the overview. Here's my investment plan. Here's where the money is coming from. Here's what we need. Here's the projected rates of return. And then the subscription document really is basically, if you want to invest and participate, Jane needs to have this document completed telling Randy how much she's going to invest and where those funds are coming from. So again, Jane will have worked with us to open up her IRA account, transfer money from her brokerage account, and then ultimately we will submit that transfer form and notify Jane when those funds do arrive back into her account. So that's initially we're setting up her account, getting the money moved, and then Jane's account manager, once her account is set up, will work with her and obviously the investment provider to complete the documents in the name of the IRA. So the subscription documents that have been provided to her, either by Upside Avenue or whomever else that she's investing with, those documents need to be completed in the name of her IRA. So Jane individually is not the owner of the investment. It's her IRA account, which is a separate legal entity from herself. So the subscriber's name, and that's the legal wording you see on the screen, is Advanta IRA for benefit of Jane Smith's IRA account. So that very clear to the IRS that this investment has been made by her retirement account, so that when funds leave that account, it is not taxable to her. It is simply her IRA making an alternative investment. And more importantly as well, the tax ID number that is used on the subscription agreements is Advanta's trust tax ID number, our trust account, rather than Jane's social. So all future earnings and gains will be reported back to her IRA, not to her as an individual. So we will ultimately sign the subscription documents. We send the wire out of her account after Jane's approved of the documents, and going forward, all those profits, either the future dividends, the payoff at the end, all comes back into Jane's IRA account. It's not taxable to her. It's not included in her income. It's simply, again, income into her IRA account. If her IRA exits the investments, again, that's no tax consequence to Jane. This is all happening within her IRA account. So, I mean, why do people typically use us? I mean, we have no lengthy approval process for the paperwork. We generally, if we have an account open, that in the cash is there, we get the paperwork done as quickly as possible within a few days at times. We offer, again, the private account manager for every client that we have opened up. It's a streamlined process involved with that, especially for people who are doing multiple, for someone if someone's raising capital and have 3 to 5, maybe 10 people investing in that same asset, we will streamline that process for all of their investors as well. We utilize DocuSign to make the process easier as well. And we have a flat administrative fee for our costs. Again, we're just charging a record keeping fee because, again, that's all we do at Advanta. We are self-directed IRAs are record keeping accounts. They're not accounts that are in advisory capacity. If you have a self-directed IRA, somebody telling you they will give you advice, I would be very cautious, because most of the companies that are doing self-directed IRAs, we're administrators, we're record keepers. We are not financial advisors. So if you have somebody telling you that, be very careful. But at this point, that's what I had to share. Jessica or Yuen, if you guys, I will give this back to you, and certainly take any other questions that people have.
Perfect. Thank you so much, Scott. That was such wonderful and informational knowledge that you shared with us. I think there was a few questions that did pop up. I don't know if you went through them. Did you?
Okay.
This one
I did not see them.
That's okay. One of them is this REIT available at TD Ameritrade?
The answer to that is that currently we don't have the custodian set up with TD Ameritrade, but if you do want to set it up through there, it is possible, but we would have to do it under their alternative platform, which we can apply for. The REIT is available through Schwab's platform. So if you are on Schwab's alternative investment platform, then we can help there. If you do want it through TDA, we can work with you to get it set up. So it won't be as smooth as with Schwab where we're already set up, but we can do it through TDA if we work with you.
What are all Advanta charges?
We charge a $50 fee to open the account, a one-time $95 processing fee to hold an investment, and then we charge a flat $295 a year to hold an investment, whether that's, again, multifamily investment or if it's a single-family home where we are taking in the income and the rents and paying the bills. It's just a flat $295 a year going forward.
Okay, and that was, I think, the last question.
Just a thank you. No, that's just a thank you. Thank you.
Well, unless there's any other last-minute questions, Scott, thank you so much for taking the time for joining us today, and thank you, everyone, for taking the time to learning more about Upside Avenue and how we invest. Hopefully, you can take some of our best practices and apply that, as well as thank you, Scott, for going over all that information about how to invest in and use your IRA.
Thank you very much for having me on.
Perfect.
Thank you, everybody.
So much, everyone. And if you have any questions, please feel free to reach out to us.